Working Man Investor. Today's video is going to be on the steps you need to understand to have a foundation in financial education. Step 1, you need to have a basic understanding of the economy and how it works. I'm going to explain this to you by giving you a very simplistic version of our economic system. First, you have employees. That's the majority of us. We go to work every day and we earn a salary. Next, you have consumers. That's everybody. Rich, poor, middle class, doesn't matter. We all have basic needs we need to buy. We all have things that we want that we spend money on. We consume, we buy things. Next is businesses. These are your entrepreneurs. They are the ones that have started the businesses that sell us the goods and services that we consume. And the next are investors. These are people that have put money into these businesses that are selling us the products that we want. So our economic system is designed to benefit businesses and entrepreneurs, not consumers and employees. The people who own the businesses and the people who invest in them are the financially educated. They understand how the system works and how to position themselves to benefit from our economy. Meanwhile, most employees take their salaries and they go out and they spend it all at the end of the month. They buy a nice car, they buy the Gucci watch, the Gucci bag, the Louis Vuitton bag. They go out to eat 5 times a week. They have a lot of nice stuff at the end of the month, but they have not built any wealth whatsoever. They make money and they spend it. And they have almost none left at the end of the month, or even worse, they have credit card debt. So they're spending more than they're bringing in. They're buying it on credit. So who is this benefiting? This is benefiting the businesses and the investors, because they're selling these goods and services, and the investors have invested into these businesses. So as the businesses are turning a profit by selling to the consumer and the business is going up in value, the investors are gaining from this too. So meanwhile, the people that go to work every day and then spend everything they make, they're stuck on a hamster wheel. You ever seen a hamster just running and running on a wheel, and at the end of the day, it's no further along. It's in the same place. A lot of people do this too. They spend all their money and they're like on a hamster wheel, and they're running in place, and they run on it for 40 years. They work 40 years of their life and they've never invested. They've never saved, never bothered to learn how to invest. And then at the end of 40 years, they're exhausted and they're in the exact same place that they were 40 years ago when they first started working. This is the problem that you want to avoid, that a financial education can avoid. So as this cycle continues, like I said, the businesses are benefiting by selling the stuff to the people and to the consumers, and the investors are benefiting because they've invested in the business. And as the businesses go up in value, the investors are becoming more wealthy along with the entrepreneurs. So how can an employee position themselves to benefit from our economy, knowing that our economy is not set up to benefit the employees? Well, you're going to have to figure out a way to have money at the end of the month to invest, or you can start your own business. You can become an entrepreneur. Now, studies have shown that only 10% of people have the mental fortitude and the desire and the risk appetite to become an entrepreneur. So it's a really, really rare person that can do it. If you feel like you have that, you need to go for it, because the world needs more businesses. They need more business creators, create jobs. So they need you to do it. If you're part of the 90% that have no desire to start your own business, that's understandable. You're in the majority there, but all of us can become investors. So how do you do that? This is step 2 of a financial education. You have to set up a system for your money. And the easiest way to do this is with the 75-15-10 rule. So what does that say? It's a budgeting method where you take 75% of your income and you allocate it to daily living expenses, your rent, your groceries, your food, your gas, your car payment. Then take 15% and allocate it towards long-term investments, and then 10% and allocate it to savings. Now, to do this properly, you're going to have to separate these accounts. Most banks are going to allow you to do this. They're going to allow you to set up the transfer per your request, and they should not charge you a fee. If 1, they don't let you do this, or 2, they charge you a fee, shop around for another bank, because there are plenty of banks out there that will not do this. So basically what will happen is you can set it up so you get 75% of your check transferred into that daily living expenses, 15% into long investments, and 10% into savings. So you're going to have 3 accounts. This is important because you don't want to accidentally spend your savings amount on your daily expenses, or you're investing on your daily expenses. Now, it is also important to understand, this is really, really important, that you only need savings for 6 to 8 months of an emergency fund. So if you lose your job, so after you've got enough to cover your expenses for 6 to 8 months, if you lose your job, you no longer need to contribute to a savings. You can take that 10% and divide it up how you want. I would recommend putting it into your investments and making it 25, but you could also do 5% in each. You have a little more money to spend and enjoy, because there's nothing wrong with enjoying your money if you're investing some of it and you've already got a 6 to 8 month emergency fund. The reason you don't want more than a 6 or 8 month emergency fund is because we live in an inflationary environment. The Fed has already said expect 2025 to have more inflation. So that money sitting in there, it's going to lose buying power. All right, so if you just keep building up your savings, you're actually going to lose money over the long haul, because that money in there is going to become less worth, have less value. So what you really need to do is you need to be investing. So 6 to 8 month emergency fund is all you need. Okay, so now that you have your system in place, you've now systemized your money. You've taken a step towards financial education, towards building your future. So next thing you want to do now, if you do have credit card debt, that is bad debt. Do not worry about investing at this time, because the investment you can make is to pay off your credit card debt. So keep saving until you get to your 6 to 8 month emergency fund, and then take that extra 10% and put it right on your credit card. So I want you to think of it this way. The average stock market return is 10%, and that's based off the S&P 500. Let's say you're able to invest and get 15% return. So you're beating the market, which is extremely difficult to do, and few people can do it. But for this example, let's say that you're able to beat the market and you're able to get a 15% return from the stock market. If you've got a $10,000 debt on a credit card with a 24% interest rate, and you're paying interest on that, over the course of the year, yeah, you've made 15%, you beat the market by 5%, but you're minus 9% because you're paying 24% on your interest rate. 15% minus 24 is 9%. Your best investment is to pay off that credit card. The moment you pay off that credit card, you get a 24% return on your money every year, because you've eliminated that interest rate. Now you're operating from a position of strength, and you can begin to invest money. So I want to tell you a quick story of what else you can do here. As I've said earlier in the video, a lot of people buy a lot of nice things. So now you only want to do this if you're serious. If you're tired of being in debt, if you're tired of not having an emergency fund, if you're tired of not having any savings, if it's starting to stress you, worry about if you can ever retire, what are you going to do if you lose your job? There's a multiple things you can do. This is step 3. You can figure out ways to make more money. So you can work overtime, you can get a second job, you can work really hard to try to get a promotion, or you can start a side hustle. The other thing you can do is you can start to look around your house for some of this nice stuff that you have that isn't doing you any good, and look to sell it. I worked with a guy that had 3 Harley Davidsons all paid off, and he's sitting in the break room with me talking about how he's worried about our next contract. I have a union job, and every 3 to 4 years, our contract is up, and we got to agree to another contract with the company. If not, we strike, or the company can lock us out. So this guy's stressing. He's got all this stuff. He's got no money saved up. He's got 2 kids, and he's asking me what he should do. I said, well, we're up against the contract now. You got these 3 Harleys paid off. Maybe you need to sell 1 or 2 of those. And he thought about it. I said, think about how much you're going to get by selling those Harleys. You could wipe out your credit card debt and have an emergency fund. I said, and I would take it a step further. I said, since you're being honest with me, you could take your 12-year-old son. He was the oldest kid who'll understand this, out in the garage. The kid loves Harleys just like you, and you give him a really good life lesson about how you've made some financial mistakes in your life. You don't have the emergency fund. You have credit card debt, and because of that, you have to make a tough decision and sell these Harley Davidsons to do what you got to do to take care of your family. And that you're going to now operate from a position of strength, you're going to have your emergency funds, you're going to buy some cash flowing assets, and you're going to hopefully one day rebuy these Harley Davidsons with that money from a stronger financial position. I said that would be a great life lesson for your son. I said, and that's the building of your legacy right there, your children. I said, you could teach him a really good life. He could learn from dad's mistakes, and you shouldn't be ashamed of that, because it takes a big man to admit that he's made mistakes and then teach that mistake to younger generations so they don't make it. Because you're on a path to be in trouble. You're going to be working a long time hoping we don't lose our pensions if you ever want to retire. You don't want to be 20 years down the line, your now 32-year-old son having made the same financial mistakes you made, and you're in no position to help him. And even if you help him, he doesn't have the financial education to do the right things with the money. So you could get yourself on a right path here, and you can get your son on the right path here. So he thought that was a great idea. He appreciated my time. I saw him 3 weeks later. I asked him what he'd been up to, if he tried to sell one of the Harleys. He says to me, no, what I did is I found a bank that'll work with union members that if we go on strike or get locked out, they'll push our payments back for up to 6 months. We don't have to pay on them, and they won't repo our stuff. And I also, because of this, bought my wife the Mercedes-Benz she always wanted. You make your choices. We all make choices in our life. That was his choice. I said what I said. I thought I gave him good advice, but those are the type of decisions that consumers make that crush them financially. And sooner or later in life, you got to pay for it. You're going to be working when you're going to be that 75-year-old Walmart door greeter wishing you could retire and can't because of the decisions you made when you were younger. This is why financial education is so important. So if you have bad debt, credit card debt, car payments, figure out ways to pay it off. If you've accumulated a lot of nice stuff that still has value, maybe it's time to sell it. Sell it, get your debt paid off, get your emergency fund, get some investments, start operating from a position of strength, and then start buying those luxury items back. And if you have children, explain to them why you're doing it that way so they don't put themselves in the same position as you. So that's step 3. Step 4, this is the last step. This is where you start to invest and buy a piece of the American economy. Here's where you start buying the assets I've talked about. So at this point, you have an understanding of how the economy works, a very basic understanding. You have a system, you've systemized your money, the 75, 15, 10% rule. And step 3, you're figuring out ways to put more money into your pocket to either get out of debt or get some money to start investing and get your emergency fund. So step 4 comes with investing ideas. So first, I got to read the disclaimer. Investing comes with risk. You can lose money when you invest and are not guaranteed to make money. You will lose money on investments, people. I've lost money on investments, but I've also made money on investments. The goal is to make more in the long run than you lose. This video is for entertainment purposes only, and you should do your own research. You do not invest and buy something based off of something you've seen off of some guy from the internet. All right, so don't buy the stuff I'm talking about just because I'm talking about it. For entertainment purposes only, do your own research. All right, so as I've said earlier, the average stock market return is 10% a year. That's based off of the S&P 500. We've had a really good run with the S&P 500. It cannot keep going up forever. We're eventually going to enter a bear market and have a year or two where it's down. So the easiest way to get a piece of the S&P 500, the S&P 500 is the 500 biggest companies in America, in the United States. So this will give you a piece of the United States economy. You can buy an ETF, ticker symbol VOO, V-O-O. An ETF is an exchange-traded fund. It's a type of investment fund that trades on the stock exchange. Similar to a stock, but it holds a basket of assets like bonds, commodities, stocks, offering investors diversification and access to various markets. As I've said, VOO is the S&P 500. So VOO will mimic the S&P 500 and will instantly give you a chunk of the American economy, the 500 biggest companies in the United States. The way to win with this strategy is the dollar cost average. So every month, whether it's the first of the month, the middle of the month, whatever, You're investing money into the market, into this ETF. It does not matter if the market's up. It does not matter if the market's down. It does not matter if it's raining outside. It does not matter how you feel. It does not matter if you want to. It does not matter if you're going on vacation next month. You invest. You designate a chunk of money, whatever it is, and you keep buying. Always be buying. You're constantly putting money into this over time, and you will make money. It helps if you're younger and you have time on your side. So now, let's say you really like studying financial reports and going through balance sheets, and perhaps that you would rather focus on buying individual stocks. That's hard to do, but I'm not going to discourage you from doing that. Dollar cost averaging is the simplest way. It's the most passive way if you're a busy working person and you have kids and a bunch of stuff going on. You don't have time to break down balance sheets and financial reports from other companies. Dollar cost average into an ETF, preferably into a Roth IRA. But if you do want to buy individual companies and you're excited about it, I don't object to that. Just remember, they do offer, buying individual stocks does offer a greater potential for return, but it also has a greater risk. You could lose a lot more than dollar cost averaging into an ETF that's diversified. So you have a larger chance of loss. So if you do want to try to find the next Walmart, the next Tesla, the next Amazon, that's great. However, you're going to have to do the work, a lot of work. Do not just go online, find some stock that some guy on the internet is talking about and buy it. That is a recipe for disaster. You will lose money that way in the long run, even if you do it once and make a killing because you found some. Don't go back to that guy and keep buying just because of what he says and you don't know anything about it. You will lose money in the long run with that. So in order to do this, you have to understand market shifts and, as I said, balance shifts. So let's say you want to invest in AI, artificial intelligence, because that is where all the money is currently flowing. First thing you want to do is look to see where the money is going. Where's the money flowing? Well, when Trump got elected, he had a bunch of AI people, had a press conference that talked about $500 billion to start going all towards AI. So if the money's shifting into something like AI, you want to start looking into AI. However, there's a lot of ways to play that, and you're going to have to analyze each of these individual companies. So you could start by looking at, say, nuclear reactor companies, small nuclear reactor companies that are supposedly going to power AI. You can look into that to see if that's something for you. If you don't like that, you can look for the next chip maker that's going to knock off the current top chip makers. You can look at data centers and companies like that. However, there are a lot of data centers out there, so you're going to have to research that. You want to look at all these companies and look at their balance sheets and make sure that they have more assets than liabilities on their balance sheet. These companies' revenues need to be going up every quarter, and they're preferably quite a bit, a pretty big jump in revenues. So when you investigate and study this and you're focusing now on becoming an investor, not a gambler. You will want to watch your emotions too. You're going to have to cut that off, even for dollar cost averaging into an ETF. You're going to have to be an investor. You're going to have to cut off your emotions. So when everybody's panicking and the media is throwing all these scary articles and the Fed is talking about transitory inflation, and then you start hearing stagflation and recession and bear market and shorting the market, and you hear all this stuff, you have to trust in your research or dollar cost average into an ETF and always be buying. That's hard to do, but you can do it. You got to think long haul. So now let's say you pick an investor. I'm going to use AI as an example again that you want to invest in. So you've decided you want to invest in AI. However, you've broken down these financials and you've studied it and you don't know what, you're not sure. You thought you wanted this, now you're having second thoughts. Well, what you can do is you can go to the ETF route. Again, there is an ETF, which I'm not telling you to buy. I'm just throwing this out there as an example. There's an ETF for AI, ticker VGT. This will give you exposure to AI without having to research all the companies that are in this particular fund. You'll treat it just like VU. You put some money, dollar cost average money into it. Now you're exposed to AI. Okay? Again, my disclaimer, do not buy any of these ETFs I have mentioned just because you saw me talking on the internet. That can get you in trouble. I'm not guaranteeing that these ETFs will ever make you money, and you could lose money on them. Do your own research. Take this information as entertainment only and go from there. So lastly, let's say you don't want to invest at all. You're not interested. That's okay. Focus now on becoming an expert in something. So what do I mean by that? Let's say, look at your passions. Let's say you're passionate about baseball cards, Pokemon cards, something like that. If you become an expert in something and it has a market, especially with today's internet access, you don't have to have a brick and mortar store anymore. You can do everything online. If you understand the market for what's popular in baseball cards, and you can figure out and build a network of people that buy and invest in this type of things, and you can get a buyer's list of people that'll buy the cards for you when you get it, and you know how to get them at wholesale prices and sell them at retail prices, you can make a really, really good money doing that. So you can also invest in yourself that way, or become an expert in something that's in demand. This will constantly keep you working even on downturns of the market and give you the opportunity to have money constantly coming in. However, even if you're going to do this, I would still recommend at least a Roth IRA, mutual funds, or an ETF, some type of investment into the American economy. So that's what I got for you today. Working man investor, keep grinding, people.